Hey, good afternoon, everyone. Can you hear me? Hello?
Hi, Professor.
Good
Oh,
afternoon,
good. You guys can hear me, right?
loud and clear.
Okay, great. Because, sometimes, this computer automatically picks um, its own, input-output device. As you can see, I have, um, okay, previously the input device was automatically selected as, I'm using a earphone, and that that earphone or the headset has its own microphone, which doesn't work actually. So um, I had to reroute it to the internal microphone that came with this computer. So okay, so well, your midterm is done. It's over, and I'm sure you can see your results. And some people may be disappointed, and some people were so stressed out um, and spent a lot of. I mean, you had only 2 hours, and uh, some people, spent those 2 hours, on something, that's rather than really working on the problems. Some people worked on, figuring out how to go about. But most everyone, except just one, only one person had, difficulty comprehending, how to uh, input the answers. Um, but it is all going to average out, because if you didn't do well in the midterm, but if you have been doing well in the homework, and as I said, each homework is 8%, 8%, right? And total of all five homeworks is 40%, which is much greater than the midterm and final alone, right? And then also, if you've been doing consistently well in the uh, in participation, your participation points really add up, and it's not even it's not even scaled down. In other words, it is every test score or homework score is scaled down because it is weighted. That weight of 40%, 25%, at least, or 20% or whatever. Um, so, but the participation points are not scaled down. It is adding up. I mean, if you, as I said, if you give me 10 great answers, that's already 40 points, just without any scaling, without any scaling down. It is 40% as is. I mean, 40 points, right? Literally. Um, Even 10 good answers would amount to uh, 10 points. I mean, so 10 great answers uh, amounts to 20 points. So there are many ways you can, um, uh, balance it out, right? Now, so we are, so since last week, we are in financial statements. I'm looking at okay, this is not the one. So let's continue with the financial statements. And let me just quickly check uh, where we were last time. The last thing we talked about. So I see there are 11 people, excuse me, 11 people here, 11 in the collaborate, and in the discussion board. Let me just quickly check. I don't have to go back there. Oh, okay. This is today, right? 0808, and I have, it says, 13, but two of the postings are by me, so it's 11. So the numbers match, on both, in both rooms. So, and what was our? let me just review quickly. That was, yeah, August 4th session recording. Let's quickly check where I stopped. Okay, so okay. Okay, so okay, we are, pretty much, we were um, in the CGS section or direct cost section of the income statement. So let me pull up the pull up again. Okay, let's see. All right, so it's not working. Okay. I have this rubber-tipped pen and to write on the screen, and somehow it's not working at all. I mean, it has to be my finger all the time. I don't know. It must be like a static, or I know that the touch screens, there are two types: capacitive, and what was the other thing? Capacitive, and the other technology is something like but the other one I forgot. The word escapes me, but this touch screen, this being used on the laptops, they are called capacitive, And all the touch screens, regardless of the technology, and there are only uh, technologies, two types of technologies for touchscreen. It uses uh, like the electrical charges, the gap in the electrical charges, between the touchscreen panel and the actual panel, um, or when you're so whatever I mean, something I read also from some sources. So I don't know. Uh, only if it is only my okay, so there is this thing, but it's really not. Again, I better not use it. So I think my whatever my pressure from the finger, right? Pressure point from the finger does to the touch screen. I think it is more effective than the rubber tip. So anyway, we were talking about the direct cost section, right, in the income statement. Remember, I'm not going to go over the whole, story all over again. Uh, and when we say income, um, it mostly means sales revenue, right? Because it's the primary source of income for any business. Every business must sell something, right? Um, Manufacturers make something and sell it to the wholesalers or retailers, right? So most of primary source of income is the revenue, and then the secondary source of income is passive income, such as investment income or rental income, right? And I've been saying over and over that the revenue, there is no better definition of revenue than price times quantity, right? And also think about it. When you get a paycheck, we don't call that revenue, right? Because you're not a business, right? Uh, you get a paycheck, but it's a kind of revenue as well, isn't it right? Um, uh, because your your paycheck is your income for selling your labor, isn't it right? Be it mental labor or physical labor. Um, basically you're selling your labor, and it's the revenue. Your paycheck is the revenue for selling your labor, right? So it's not too.
I don't like it, bro.
Were you saying something to me, or um, so? Uh, but in a personal case, right? In personal income, right? We call it income. We don't call it revenue. But in essence, you understand they are one and the same thing, right? Now, again, uh, expenses. Primary source of expense is direct cost, which is cost of uh, actual inputs of production, and inputs are basically capital labor and raw material, right? So it's the cost of direct input, and in microeconomics is called uh, let me go with the accounting. In accounting, they call it cost of goods sold, CGS. But in microeconomics, they call it total variable cost, right? Because is the cost that changes, varies. Think about the word vary. That means it varies with the quantity produced, right? It varies. In other words, total uh, total cost will go up. It varies, right? So it goes up if the quantity or the output or production level goes up, right? So therefore, uh, this can be rewritten as average variable cost times quantity, right? Quantity produced, right? And I also explained that um, average variable cost means production cost per unit, right? Cost uh, per unit, right? So it's obvious, uh, the relationship between total and average. We talked about this last time. The relationship between total and average is literally quantity, right? Average times quantity is total. Total divided by quantity is average. So, and then think about it. Total cost divided by quantity is exactly production cost per unit. So, average variable cost is the same thing as production cost per unit. And also last time I talked about why it's the same thing as CGS, because I told you um, cost of goods sold is not exactly the same thing as the cost of goods produced. Actually, if you think about it, TVC, total variable cost, is the cost of goods produced, right? But we all know that in reality, you may not the quantity produced is not exactly may not exactly be the quantity sold, right? Um, but eventually, I told you, eventually they will be equal, because um, if you produce 10,000 units, but and you're selling them for $500 per unit, uh, and at $500 price, if you can only sell the maximum sale you can push is 9,900 units, and then there are 100 units still left. And what do? You you put down the price, right? Just lower the price, and then it will sell. So eventually, uh, cost of goods sold will be equal to cost of goods produced. So that's the reality. And I also told you in economics they use uh, perfect universe assumption. What does that mean? In a perfect universe, we have a perfect foresight. And if we have a perfect foresight, our demand forecast will be impeccable. Our demand forecast will be very accurate. So we know exactly how many units will be in demand. So we only so if our demand forecast is 10,000, we make only 10,000, which is exactly the demand quantity demanded. Uh, so there will be no surplus or no shortage. Of course, reality is not like that. Uh, our demand forecast cannot be perfect. Um, so that's why only 99,900 units were sold, and 100 uh, units were left, and they are called surplus, right? Uh, but in reality, even if that's the case, as I said, by reducing price, you can exhaust all the inventory. You can get rid of, you can move out all the inventory, right? It's um, and also in Um, but with the perfect universe assumption, um, there will be no surplus, no shortage. So the market will always clear, right? In other words, when quantity demanded uh, is equal to quantity supplied, quantity produced, right? Then that's the market will clear, right? Market, that's called market clearing condition, and market will clear all the time. So then, cost of goods sold is exactly the cost of goods produced. So we have no problem equating total variable cost with cost of goods sold. Okay, and then the other one is, a secondary source of expense is operating expenses. And I told you, operating expenses is like uh, uh, indirect cost, direct cost, right? Which means it has it is not directly related with production, right? Now, total variable cost or cost of goods sold is directly related to production. It's in direct proportion, right, to the production level, right? So as the production level goes up, uh, as the production level goes up, uh, this goes up. As the production level goes down, this goes down. Uh, However, operating expenses are relatively constant, and it doesn't change with the production level. So it is also called total fixed cost. And total fixed cost, um, there's a little, excuse me, there's a little, total fixed cost is not exactly the same thing as operating expenses, but they are roughly equivalent. This means, approximately equal to, right? Or, roughly equivalent to. They are roughly equivalent to each other, but they are not the same thing. Why? Because in microeconomics, the focus is more on the initial investment. In microeconomics, this is uh, mostly focused on initial investment. And the initial investment is also called sunk cost. Okay, sunk cost. Um, but before I move on, let me. So basically, we understand if we subtract the expenses from income, we arrive at the we arrive at operating profit. Now, I've been telling you, uh, if you subtract expenses from income, in other words, subtract cost from revenue, then what is it? Roughly, it is called roughly, profit, and pi, Greek character pi, is the symbol for profit in microeconomics, whereas it is, symbol for inflation in macroeconomics. So it's an old convention. It's an old convention in economics. Um, so, um, but in accounting, they all still call it operating income. Uh, They use multiple terms, right? So you should recognize them. You should know them by all the terms. Operating profit or operating income. But I've been telling you, I don't like to use the term income here at this point, at this stage, because income is this. This is gross. So income is in gross state after subtracting expenses. Then if you still continue to call it income, then you might get the idea, oh, income means profit. Then, you get you confuse it with profit. I mean, you think, oh, then this can be called, we can call this also profit. No, this is not profit at all. You should never call this profit, right? So this is what I don't like about accounting. But they also have their own, rationale for that, um, because they use the term income. I mean, if in personal case, right? In personal case, um, think about it. You receive, your annual paycheck. Your annual salary is, let's say, your annual salary is 60K. Let's say, okay, your annual salary is 60K. So then after, from 60K, what will you do? First of all, uh, taxes already, withheld before you receive, paycheck. But ignore that. Ignore that. Let's say we are paying taxes later. But first, then of course from the paycheck, you will pay out the expenses, which are basically for you. You have direct cost and indirect cost. Your direct cost is food, clothing, transportation, right? The basic necessities are food, shelter, clothing. But shelter is not direct cost, because um, no matter how long hours you work, no matter how productive you are or how unproductive you are, your rent doesn't change, right? Your rent doesn't depend on that. So mostly, it's your direct cost would be food and transportation, because the more hours you work, the more, or at least the transportation. Okay, maybe the transportation would be fixed cost as well, because you would commute, no matter how many hours you work, no matter how productive you are, or you commute just once, one way, 2 ways per day, right? And these days you don't even have to commute; you work from home. But whatever is related to your, let's say, the more you work, the more utility bill, right? You will have to, because the more you work from home, uh, you use more electricity, right? More, Wi-Fi time, more, hours uh, using electricity. So your electric bill will commensurate with your, hours worked. So uh, anyway, you subtract all the expenses, right? And whatever is left, so food, shelter, clothing, uh, transportation, telecommunications, social life, all the expenses you subtract from your paycheck, from your income. And personal income, you don't call it revenue, although it's pretty much in the same vein. And then after subtracting uh, your expenses, then uh, it's called, your discretionary income, right? When you subtract those, expenses, the rest of it is sort of like profit for you. Profit, right? But then it's like, operating profit, but it's not called profit, because uh, it's personal income. Then because of that, in a way, you can call it your uh, operating income. I mean, in that vein, that's why in accounting they call it operating income as well, right? Um, but again, just because of, uh, personal, personal finance example, uh, they are using these operating profit and operating income interchangeably. Uh, but we need to make clear distinction. I mean, as long as we are looking at the business um, income statement of a business, then um, it's much better to call it operating profit, right? And then another way of calling it is called EBIT, right? We talked about this last time, didn't we? We already talked about this last time. Anybody? What EBIT stands for? Anybody?
Earnings before interest and taxes.
Yes, yes. And who is this?
Shirley.
Shirley. Okay, so 20808, business 210. Yes. Um, Shirley, you're getting zero point 0.5 for that. Yeah, earnings before interest and taxes. So uh, keep in mind all the steps from uh, the process from here to here, right? From revenue to operating profit or EBIT, that process is called operating activity. Operating activity. And this is very important. Why? Because all the businesses are engaged in three types of activities. All businesses are engaged in three types of activities. First of all, operating activity. Second, investing activity. Third, financing activity. So what does the we already understand what operating activity means, when they say operation, I mean for business operation, right? Operation can be there's military operation, there is medical operation, which means surgery, but in terms of business, right? Operation means only one thing: you make and sell something, right? And then pay out expenses and arrive at operating profit. That's operating activity. That's operation. Otherwise, what other operations can there be for any for-profit business, right? For non-profit businesses, it may be slightly different, but basically, you have to sell something, right, and pay out expenses and arrive at operating profit. Now, investing activity is basically acquiring, right, physical assets like physical assets or physical capital. In other words, acquiring plant and equipment. Now, if you're a manufacturer, right, there can be no manufacturing without plant and equipment, right? You have to have production equipment. That's the difference between difference between manufacturing and retail. Because retail, they don't produce anything, but instead they buy from the manufacturer, right? So although they didn't make anything, they pay for uh, they basically pay for the cost of uh, the manufacturer's cost of making it. Uh, but anyway, investing activity is basically uh, acquiring uh, production equipment, right? Land and building, plant and equipment, and land and building, right? That's investing activity because without investing activity, right, there can be no production. And then financing activity, right? So either acquiring and disposing, disposing of these, acquiring these assets and disposing of these assets. That's investing activity. Financing activity is basically how do we support this activity, right? Investing. So how do we raise capital? How to raise capital? Think about it. It will cost a lot of money. Plant and equipment would cost tens of millions of dollars at least, right? Of course, we're not talking about the rubber band plant, rubber band factory, or a paperclip factory. Paperclip factory or rubber band factory may probably, it will still cost probably some in the some amount in the order of, like some $100,000 to $1 million, but it won't be like tens of, or hundreds of millions of dollars. And rubber band and paperclip is relatively very, very low tech, right? Isn't that right? It's very low tech. Uh, uh, but if it is a high tech, the high tech product, right? Industrial products, high tech industrial products. The technology, the plant and equipment that where the technology is implemented, it would cost a huge amount of money, right? So how do we raise capital to, how do we raise capital to acquire, those assets, those, physical assets or hard assets, right? And then when those, sometimes, you sell off part of your plant and equipment, because if the company is if the company is not doing well, but plant and equipment basically costs money to maintain, and if some division isn't making money, right? Some division is losing money. Their equipment and plant must be disposed of, to save on it cost, and then by selling off those plant and equipment, they make their cash flow. They enhance their cash flow, and they can use that to they can use the cash generated from sale of those assets for investing in other projects, right? So those are financing activities. But investing activity, financing activities, we're not going to talk about that further, but we'll be mostly talking about operating. But actually, these other activities are pretty much well captured in the balance sheet. Okay, investing activity and financing activities are well captured in the balance sheet. So then let's think about the what is okay, so just the expenses part. We know, of course, cost of goods sold is total variable cost, right? Which is also ABC. Times quantity, right? Second, operating expenses, OPEX, roughly equivalent to a total fixed cost. And I told you, this total fixed cost is microeconomics terminology. And what is fixed cost? Think about it. Fixed means it doesn't change, right? but it, what it what it means is it doesn't change. It doesn't change with the production level, right? Uh, Depending on the think about it. Um, when the company started out at time zero, right? Think about it. And then T1, T2, T3. Let's say this is assume a manufacturing business. So for a manufacturing business, definitely you need to, you need to have plant and equipment. So you have to build it. Construction will take, let's say, about 2 years, right? Construction of this. So during the first 2 years, there's no operating activity. Think about it. You cannot make anything, so you cannot sell anything until the plant is completed. At the end of year two, the plant is completed. So from year two, there can be revenue, right? From year two, but until end of year two, there is only initial investment, right? And suppose it costs it costs $10 billion to build uh, this plant. So for the first 2 years, there was only initial investment. There is no income. This 10 billion is fixed cost. Think about it, because this expense is already incurred. You already put this money into this business already. That's why it is called sunk cost. Also sunk. In other words, this 10 billion is sunk into this project. This 10 billion is sunk into this project. There's no the only way, if you want to recover this 10 billion, the only way is by producing something and generating income, sales revenue from it, and it may take a long horizon, long output horizon. In other words, quantity horizon, right? To recover this 10 billion, it may take 5-6 years, even after from this end of time 3. End of time 3 is the beginning of time 4. Or in our example, from end of time 2, end of the year 2, right? Because the construction is completed at the end of year 2. So from year 3, it generates income, but it may take many years, right, to recover 10 billion. Not to be exact, it's better to count it by production horizon rather than years, because it may if it may take 10 million units, selling 10 million units to recover this. And so how many years will it 10 million sale of 10 million units cannot happen just overnight, or because you have production capacity, maximum production capacity of your plant per year, right? Maybe like only 100,000 units, 100,000 units per year. If it is 100,000 units, to produce 10 million units, it would take how many years, right? To produce 10 million units, right? By simple, it would take 100 years. Of course, it should be less than that. I mean, who can wait 100 years just to recover their initial investment? But the idea is, this is why it's called sunk cost, right? And you understand why it would, why it would cost. Of course, depending on the kind of product, if it is high tech, product, of course, uh, it costs a lot to make it, and you sell it at a high price. I mean, uh, mobile phones, uh, you can't you can't you can't make mobile phones if you don't have technology in the first place, right? Number one, you have to have that technology. And number two, uh, capital. In other words, financial capital. Without the financial capital, right, huge financial capital, it will cost huge financial capital because you have to build a plant, which is a high-tech plant, which will cost probably like $1 billion or $10 billion. But first of all, uh, these are already the entry barriers, right? Unless you are uh, unless you are some uh, unless you're someone or a group of some group of people, right, that have the technology and that can afford to raise the capital to right to build this type of plant, uh, you cannot even enter this industry. Isn't that right? That's called entry barrier. I mean, not anybody can, enter the, mobile smartphone industry, right? Someone with only, the technology that can make paper clips cannot enter, right? Mobile phone industry. Someone, a company that has only, in other words, rubber band manufacturer, rubber band factory cannot enter mobile phone industry because they don't have technology, they don't have financial capability to do that, right? There was already entry barrier. But anyway, the point is, total fixed cost in microeconomics focuses more on this initial investment. In other words, the sunk cost. And the sunk cost doesn't change with the production level. Well, of course, over time, when uh, sometimes you need to expand, sometimes you need to expand the production capacity. Expanding production capacity means, adding additional plant and equipment. Uh, then the total size of the plant and equipment will increase, which means, more fixed cost, right? Uh, But that doesn't mean clearly it's a different thing. I mean, although the initial investment and then there will be follow-on, and there can be follow-on investment. Uh, why? Because the size production capacity is determined by production capacity is a function of dollars. Production capacity is the function of initial investment, right? Think about it. Production capacity is determined mainly by the size of the plant, right? The size of the plant is exactly the function of initial investment. Isn't that right? Size of the plant. And the size of the plant means, it's not just, dimension. I'm not talking about the dimension, but, the bigger the plant is, the bigger the plant, the bigger the equipment. Isn't that right? the bigger the plant, the bigger the production equipment. So the bigger the production equipment, the bigger the production capacity. And obviously, a plant that cost $10 billion to build would have roughly about 10 times the production capacity of a plant that was built with $1 billion, right? Does that make sense? Of course, it may not be exactly, exactly in that direct proportion, verbatim, but we can approximate it. I mean, a company that was built a plant that was built with $1 billion, size is already capped, or the production capacity is already capped by the size of that capital, right? And then, so roughly, $10 billion fixed cost, $10 billion initial investment will build a plant that has roughly about 10 times the production capacity of a $1 billion plant, right? So in microeconomics, that's what they focus on, right? The sunk cost for the initial investment, which doesn't change with the output level or the production level, right? However, in accounting, as I said, fixed cost can change over time because if they add more capacity to the plant, I mean, years later, right? Years later, their maximum annual production capacity is, let's say, 100,000 units of whatever, a Tesla cars, or everything, is physical, isn't it right? I mean, production capacity is, a physical thing. Plant size is a physical thing. There is a limit to a physical capacity, isn't it right? All physical assets have physical production, maximum production capacity. So it's all, so years later, the maximum production capacity was like 100,000 units a year, but years later they may need to increase this. To increase that, what do they need to do? They will need to build more plant, or add more plant, or it may not be, it may be a separate plant, but you can, if there is a physical space, right, you can add an annex to the existing plant, right? Or so then that's follow on investment in their physical assets. If that is the case, I mean, they add $5 billion more to their existing plant size, then production capacity would be 1.5 times previous, to the previous production capacity, and then their sunk cost would also increase. But once again, still, that doesn't have anything to do with the output level, right? In other words, as we increase under the given maximum production capacity, as we increase the production level, or decrease production level, right? The initial investment doesn't change. Okay. Now, but in accounting, when they call it operating expenses, and operating expenses are focused more on day-to-day, the expenses that are related to day-to-day operation, right? So most of all, a large part of it is rent. Think about it. If you rent your business space, right? Rent doesn't change. Rent doesn't change with the with your output level. Just suppose you are running a coffee shop. Let's say you own a coffee shop, and in coffee shop, right? In coffee business, right? There are also direct cost and indirect cost, right? Direct cost uh, is what? Think about it. Direct cost will consist of capital labor, raw material. And we know what capital is. Coffee machine, espresso machine, and things like that. Uh, and direct cost is always, think about it, per unit. I mean, if you make coffee and let's say you make cappuccino and sell cappuccino for $5 per cup, right? And then direct cost is, the cost of using the coffee machine. Let's say, all of that per unit, total per unit is, let's say, $3, $3 per unit. And I would say most of it is labor. If you're hiring a barista, probably about $1.50 will go to the barista, right? $1.50 will go to the barista. And about 75 cents, 75 cents will go to the espresso machine or coffee machine or whatever, espresso machine. And raw material, the other about 75 cents. The other 75 cents would be the raw material. The raw material, coffee bean, water, right? Sugar or sugar substitutes, right? And then creamer, cream, milk, or whole milk, all those things. And also, the paper cups, for. So those are the things that go into making coffee. Those are the direct costs that goes into making a cup of coffee, right? And so if you sell and we know what's going to be your revenue, right? Total. This is I introduced this symbol before. It means total revenue. Total revenue. We know revenue is price time. What's going on? Revenue is price times quantity, and we know the price. You're selling espresso or cappuccino for $5 a cup, right? And if you sell one, it's going to be $5. It's in direct proportion to the quantity, right? So it goes up. This goes up if this goes up, right? Isn't it right? And the total revenue goes down if this goes down, right? However, and then also total variable cost, in other words, which is this direct cost is we assumed $3 per unit, so that's the production cost per unit, or it's AVC, average variable cost. So total variable cost will be also AVC times quantity. We know if quantity produced, in other words, the output level, production level, if it goes up, this goes up too. If this goes down, this goes down too, right? And this is $3 per cup, right? That's variable cost. But clearly, what is not variable or what is not changing with the production level is something like rent, right? As I said, microeconomics, I told you, microeconomics focuses, uh, as far as total fixed cost is concerned, microeconomics focuses more on the initial investment or sunk cost, but accounting's focus is more on uh, something that doesn't change. Of course, total fixed cost means something that doesn't change, with the production level. Also, something that doesn't change with the production level, something like rent. So you rent this space for your coffee shop, and the landlord will still charge you the same rent. I mean, you will pay the same rent during the lease period, right? As long as you lease the place, uh, you pay the same rent every month, regardless of your production level. I mean, during some good months, your sales revenue may double during some good months, but you still pay the same rent, right? During a bad month, your sales revenue may be slashed by half. Still, you pay the same rent. So that's what, also, another example of operating expenses. There are, things that basically, I don't, there are like minor line items, rent, marketing expense, R&D expense, blah, 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 um, depreciation, and things like that, right? Um, these are operating expenses because depreciation doesn't depend on a production level either. And another thing, think about it. Some salaries and wages are relatively, especially the salaries and wages that go to clerical staff. I mean, when we say workers, when you say employees, you got to make distinction between the two. Employees that are directly engaged in production activity and the employees who are not engaged in production activity. Uh, I think it's already 4:13 for so I think this is a good time to take a break. So let's take a 10-minute break and we'll come back, reconvene at like 4:25. Okay? All righty. So where am I? All right, let's take a 10-minute. Okay? All right, we're back. We're back. Um, so, um, right before the break, I was talking about the two categories of employees. Um, obviously, one type of employees is the production workers who are directly related to or directly engaged in production. And the other type is non-production workers, such as administrative or clerical, right? Administrative or clerical. Now, think about it. Barista is clearly a production worker, a type of production worker. So, um, barista's hours will increase. I mean, in reality, of course, you will have to pay the barista no matter, basically some fixed for a fixed number of hours. Maybe, it would be easier to, in reality, do it that way because you don't know when uh, the demand will surge or when the demand will be slow. You don't know. So you pay him, regardless of how many cups of coffee the barista actually made. You just pay him for 8 hours a day or something like so. It's more like uh, fixed cost. However, uh, let's think of it this way: if you pay the barista by the number of cups he made, right? By the number of cups of cappuccinos he made or espressos he made, so then uh, his salary is part of the think about it, his salary is part of the CGS, isn't that right? His salary will be part of, in other words, his wages will be part of the cost of goods sold because what goes in the cost of goods sold or TVC, but by per unit it's going to be AVC, average variable cost, or per unit production cost. And as we assumed, you pay $1.50, per cup made, right? Did I assume dollar? Yeah. So then, the higher the production or higher the number of, higher the amount of coffee sold, right? The higher his cut in the average variable cost. And then if the output, if the production is like doubled, if the production is doubled or tripled, in other words, in a particular month, the business was so good that we doubled, not just tripled, quadrupled our production. Let's say on average month, on a regular month, average month, right? On an average month, the quantity sold, let's say 10,000 cups of cappuccino, 10,000. 10,000 cappuccinos, right? Cups of cappuccinos. But in a very good month, extraordinary month, let's say this was 100K, 10 times the regular month. Now, obviously, one barista can't handle that. right? You will have to hire more baristas, right? Now, but the idea is, uh, so let's switch the example to automobile manufacturing, automobile plant, right? Uh, and on an average month or on a regular month, uh, the produced cars produced 10,000 units. Cars produced are 10,000 units, right? Uh, and if the demand doubles, right? I mean, double already, double the demand is already, uh, uh, realistic. There are realistic constraints, but demand can increase like 10 to 20%, right? 10 to 20%. Uh, but in reality, doubling, 100% increase cannot be handled by uh, it cannot be handled by any automobile manufacturer. Why? Because your production, as I said, your plant and equipment has physical limit, right? In it, your plant has physical limit in production capacity, and usually, companies run at about 80%. Uh, Generally, somewhere between 75 and 85% of the uh, on average, they run at 75 to 85% capacity, right? So there will always be about 20% excess capacity, and it could be 10% or 20%. It could be, but so you can increase the production by realistically by about 10 20%, but beyond that you can't. But let's forget about the reality, and let's say the demand doubled, so production capacity doubled. uh, and then if that's the case, everything will have to double, isn't it right? That means capital, labor, and raw material will have to double. If everything doubles, capital, if the quantity doubles, right? Everything, input, the factors of production will have to double. Capital will have to go up, right? Labor will have to go up, right? Raw material too. Well, there will be double because if the production level has doubled, then all the inputs must also double as well. Now the thing is, I said there's a physical limit to this, but let's say it's possible, right? This is definitely possible. Also labor. There are two ways you can do this, right? You can hire twice as many, right? You will have to hire twice as many, right? Twice the number of current workers, or you can make them work double shift, right? In other words, uh, you make them work double the time. Of course, this can be. You have, let's say, your production workers. There are 100 of them. Making them work, and they generally work 8 hours a day. But for extra pay, I mean, for double pay, uh, they may be able to work double time. But of course, human beings are, even the machines will break down if you work double time for a long extended period of time. Not I mean maybe 1 or 2 days, 3 days, maximum 1 week. You may work double time, and you wouldn't mind because you're getting double pay, right? Double the pay. Um, think about it. This is possible if only up to a certain point, because you will collapse beyond 1 week. If you work double time, you will collapse. Physically, you can't take it. Even the machines won't be able to take it. It will break down, right? If the machine runs at 200%, how can the machines run at 200% capacity? They will. The maximum they can run is 100%. But let's say you push the limit, and the machine will break down, right? So one option is making them work, double time, or hire another 100 workers, right? But then reality, this makes it actually it is there are many constraints to this. First of all, if you are talking about, our example is automobile factory, and in an automobile factory, uh, it's not just anyone you pick up from the street. The auto workers are sort of skilled worker, skilled labor, right? In other words, you have to have been trained, and you have to be skilled in certain. They are mechanics basically, and uh, it's a unionized job. It takes training. It takes time and training to become a certified mechanic. And automakers, the production workers are basically certified mechanics. I mean, uh, some are specialized in, like engines. Some are specialized in fuel system, and some are specialized in electricity. And so think about it. How can you increase? How can you double the number of skilled workers overnight? Reality, in reality, that's not possible, right? It doesn't. So reality doesn't make it, feasible. So most likely option is, making them work though. But let's say still, nevertheless, we just assume that it is possible. First of all, you don't find reality is that you can find this skilled labor from the street. I mean, that means what were they doing? I mean, why are they on the street? They are. That means, unless they are all unemployed, right? Uh, unless these 100 auto workers are unemployed, right? There's no way you can find them on the street and pick them up from the street, and put them on, deploy them to the production line just overnight, right? And as I said, on the if the economy, now, why is the output doubled? Because the demand has doubled. That means a good economy, right? Even overheating economy. And then in an overheating economy, the labor market is very tight, meaning you can't find idle workers. You can't find idle skilled labor. So realistically, doubling the number of workers is unfeasible. But let's just assume that it is feasible. You double. Next problem is when, okay, so you hire them just temporarily. I mean, uh, they are temps, and when the production level goes back to normal, what do they? What do we do with them? Because they were temps, we just lay them off. Once again, this is not reality. Is not like that. Skilled labor, uh, it's hard to find, especially labor market when the economy is good. Labor market's tight, so it's hard to find the skilled labor. Um, and uh, if you hire them, it's hard to fire them too, right? Why? Because as I told you, it's unionized, right? These jobs are unionized, so once you hire them, it's really hard to fire them. Even if you hire them on a temporary basis, then uh, once the output level goes back to normal, then it will be a headache, right? What to do with them? So, but anyway, let's say it is possible. Then think about it. Labor, um, you need twice as much labor, which means either making them work double time, which is only just temporarily possible because uh, you cannot push it more than a week. Uh, Physically, it's not possible. Otherwise, you double the number of workers. Now, either way, you double the number of workers, the wages will double. Total wages that are being paid will be doubled. Total wages being paid will be doubled. Uh, Either by hiring twice as many workers or by making them work double time, right? But by making the existing workers uh, work double time. Uh, so in other words, um, the reality is these existing workers, they are on a salary, right? So uh, up to a certain point, uh, they don't up to a certain point, they just get salary. And then if they work overtime, that overtime will uh, so salary is fixed, right? But uh, the overtime will then factor into the direct cost, right? The over uh, so we understand that the salaries and wages paid to the production workers will double when the production level doubles. But let's think about the salaries and wages to the administrative and clerical staff. Now think about it. A very good example of clerical staff is secretary, right? Now, what happens to their wages when production level doubles, when the production goes up, right? When the output level doubles, does the wa- does the wage is the wage pay, does the wage paid out to the administrative staff also double? Does it also double? Hmm? Can anyone answer this question? What do you think? When the production level doubles, the wages that go to the administrative staff, or salaries and wages that go to the administrative staff, or clerical staff, or secretaries, the total wages, right? Will it double?
Yeah,
Definitely.
Oh, why? Why does it
they're
double?
doing more work.
Are they, but do they work, do they work double time? I mean, the amount of work they do, does it also double?
Yeah, if they're hiring more people, then that's twice as much work for them.
No.
No.
Hiring hiring twice as many people, that's true. But uh, the work that is being doubled is the work of the production workers, right? Now, these administrative and clerical staff, they may work, probably they need extra, they may have to work some extra hours, but they're it's not like, think about it. When the production level doubles, do you need to hire twice as many administrative staff or clerical staff? Do you, when production level doubles, do you need to hire twice? Do you need to double the number of secretaries? Let's think about it. When the production level doubles, do you need to double the number of secretaries?
No.
Of course not. The answer is no. Why? Because secretaries are not directly engaged in production activity. Administrative staff are not directly engaged in production activity. Those who work double, the number of workers on the production line or their hours must double, but the number of secretaries do not have to double, or their hours do not have to double. You understand? They may need to work probably some extra hours because when there are twice as many workers, or if the workers work double time, administrative staff may have some more chores. They have just some more chores, but they don't. Secretaries do not have to be doubled. Number of secretaries do not have to be doubled. They just do some extra work and they can get paid overtime, right? But it's not like, the company has to hire twice as many secretaries. You understand? So in other words, the wages, so that's why I've been telling you, we have to separate, we have to differentiate between the workers that are directly engaged in production activity, right? So-called production workers who are really working on the production line, assembly line or production workers. And then non-production workers, or the non-production or clerical, right? Administrative, clerical, right? Workers, secretaries. So think about it. Their salaries, their wages are mostly fixed cost, or in other words, operating expenses. Production workers, part of their salaries would belong to as I said, in reality, they would be salary based and they will get paid overtime. Because when production level doubles, then their overtime will almost double their salary. But part of that is operating expenses, but that's in reality. But if we simplify this assumption, and our thought experiment, this is like the salaries and wages that go to the production workers that belong to direct cost. In other words, it's part of the CGS. It's part of the CGS. Okay? Now think about it. So what is the operating expenses? The operating expenses, and I've been telling you, in accounting, they're focusing more, as opposed to the microeconomics, which focuses more on the sunk cost, right? Accounting focuses more on day-to-day operating expenses. And of course, first, it's like rent. Two, depreciation, which is basically coming from the balance sheet later. You will see. Three, salaries and wages. Salaries and wages, that most of it, right? Administrative staff, clerical staff. Because it doesn't change with the production level, right? It doesn't, it may, as I said, secretaries may work some extra hours, right? When the production level doubles, right? But then it's not like, production line workers who has to really double their hours. I mean, if the production production goal, production level is doubled, then they really have to put in double the hours, or you have to double the number of them. Whereas administrative, clerical, they may have some extra chores, right? They may have some extra work, but it's not like you need to double the number of secretaries, right? So these things are operating expenses. Okay. Now, so we understand the distinction between the and as I said, operating expenses are roughly equivalent to the total fixed cost. And I've been telling you the focus is different, right? Microeconomics puts more on the sunk cost. Operating expenses. Also, of course, rent, depreciation, wages, salaries, rent, depreciation, salaries. Again, so does that mean operating expenses ignore? Does that mean, does it ignore sunk cost? No. But what it does is, unlike, think about it. In microeconomics, sunk cost is always, perceived in total dollar amount, total big chunk, total dollar amount, like 1 billion, 10 billion. But now in operating expenses, it will have to be because the basic operating period for any business, right? The most basic operating period for businesses is quarterly. In other words, they report their income statement result. Their income statement result is what? Net profit. They report their income statement result on quarterly basis, right? And report to whom? Report to whom? To the they report to the what's the they reported to SEC, quarterly report. They file quarterly report with SEC. What's SEC? Security Exchange Commission. So that's and if they report to Security Exchange Commission quarterly, that means they are publicly traded companies, publicly traded. Publicly traded. What does that mean? They sold stocks, and their stocks are being traded in the market. Okay. However, if the company is not public yet, in other words, privately held company, they have no obligation to do that. They have no obligation, but it's just accounting. It's just accounting practice to update their income statement and balance sheet quarterly, on quarterly basis. So basically, basic operating cycle or operating period is quarter, right? Quarterly, and then think about it. Of course, they collect their data on daily basis. They collect their data on a weekly basis, and collect their data on monthly basis. But when they compile the data and release the data, report the data, release the data to the public, right? That's on quarterly basis only. But anything prior to that, any data they collect, monthly or weekly or daily, that's for their internal purpose. They're only for internal managerial purpose, right? So, if so, with the quarterly, data, now think about it. The company makes a projection. So in other words, we are here at time zero. Let's say time zero, time one. Oh, let's consider that quarter, right? Because as quarterly basis. Uh, quarter one, quarter two, and let's say quarter three. So think about it. They will have to figure out, okay, I mean, if $10 billion was the sunk cost, right? Or total fixed cost, how long, how many quarters will it take? And I told you, it's not in terms, or how many years will it take for us to break even? Meaning, until you break even, there's no profit. But when you break even, that means you have recovered all of this, right? When you break even, you have recovered all of your sunk cost or total fixed cost. And then if we can find where, is the break even, where does break even happen, right? If you can find out at what output level, this is quarter, but this means quantity. So will it be like when 100 million units or 10 million units, when we produce 100 million units or 10 million units, when do we break even? So rather than time horizon, right? You can also indicate it or pinpoint it on the output horizon or quantity horizon, output horizon, right? So do we break even at 100 millionth unit or 10 millionth unit, whatever, right? And then you spread it over. And so annually, what is our maximum production capacity? If annually, if we can make 1 million, or if we make annually 10 million units we can produce, then it will take about 10 years to if our break-even point is 100 millionth unit, it will take about 10 years for us to break even. I mean, we can find so in the operating expenses again. So as I said, there will be rent, depreciation, salaries, and then this fixed cost spread over, in other words, break-even quantity spread over over the production horizon, and then that break-even quantity, broken down by quarters. In other words, so how many per quarter? What is production cost? I mean, something like that. So in other words, that fixed cost spread over a long, if it takes 5 years, to break even, that fixed cost spread over like 5 years, broken down into broken down quarterly, right? Uh, that kind of fixed cost will be also reflected in the operating expenses. Okay, so that's the basically how operating expenses breaks down. Okay, so this is something that you have to really sink into your mind, right? Just like the sunk cost, it has to sunk into your mind, right? And then eventually, right? We already talked about this, I believe. We talked about what happens after EBIT, right? We talked about, total revenue is price times cost. And then CGS, which is, or TVC, which is average cost times quantity, and OPEX. We subtract that, and then we arrive at operating profit, which is the same thing as EBIT. And then, because it is EBIT, right? Next comes, everybody should be clear about this by now, right? If you are still, so what comes after, what comes next? When you're here, what comes?
Earnings before taxes.
No, you cannot just arrive at earnings before taxes without doing this. So what should come next? What should happen next? No one can answer this again. I mean, we spent so much time on this, and no one can look. Interest must be paid first, isn't it right? Everyone should get, minus 5 points for not knowing this, not being able. The name is, think about it. The name is earnings before interest and taxes. So then what should come next? Interest payment must come next, right? We went over this. And then, so we subtract interest then, because interest is dropped, then what does this become? Because I is dropped, so what does this become?
Taxes.
Why taxes? Interest drops out, I drops out, then what should it be? Oh, Jesus. We went over this, with so much,
To say that's interest before taxes before.
yeah, what happens? So it's something that comes before taxes. So what is that called? It's something that comes before taxes. So what is it called? Shouldn't it be called earnings before taxes? Someone already said earnings before taxes before, but why can't you make that connection? I dropped out after paying interest, right? After paying interest, I should drop out from that. Then if I drops out, then it should be EBT, earnings before taxes, right? And another name for that is taxable income, because that's the income before paying taxes, right? Taxable income. Then comes what? Then comes what? After this, then comes what? It's earnings before taxes, so then comes what? What should come
Earnings
first?
after taxes.
Yes, after taxes. Who said taxes?
Shirley.
Okay, Shirley. So look, now it's time to drop this, right? So after paying taxes, right? After paying taxes, then the result is called net profit. Also in accounting, they call it also net income as well. But if you follow this column of logic, if you follow this column of logic, this column of terminology, because this column, the right column has has a logic to it, logic behind it. So what should it be called now? Net profit is the same thing as, it's also called. By now, you know, we talked about this before, so this shouldn't be, it should be called EAT. It should be called EAT. Isn't that right? Now it's earnings after taxes. Earnings after taxes, right? Because you pay taxes after. Previously, it was before taxes, so it's earnings after taxes. So, I mean, this is like almost a review of, you know, we already went through this, and this is almost like a review of the same thing over and over. Not so many people are, you know. Okay, so today, Shirley got another 0.5, so that will be 1 point. Okay, so that's it for today. Okay, that's it for today. So I'm still working on your homework too, so I'll be able to return it by tomorrow or end of tomorrow. So let's. Okay, so if you have any further questions, please, you know, email me, and you know, I have, you know, today I'm booked, you know, tomorrow I'm booked, you know, I guess Wednesday I'm booked as well. So the next available office hour will be Thursday, I guess. So, okay, so so that's we'll call it a day here, and I will see you guys, you know, tomorrow. Okay. So have a great afternoon, everyone.
Thank you, Professor.
All right, you're welcome. All right. So I'll stop recording.